What's up, family? Here's another edition of What's in It for My Money. I am your host, Andre Gordon. Please don't forget to smash that like button and subscriber button to become a part of the family and to get updated weekly content. Today's episode is about Bitcoin. Bitcoin has been much talked about and debated in the investment and the financial world. So today we're going to look at what Bitcoin is, a summary of its origins, history, and the pros and cons of using Bitcoin as an investment tool and what's in it for you and your money. What is Bitcoin? Bitcoin is a digital currency that was created in January of 2009 following the housing crisis. It follows the ideas that were set out in the white paper by the mysterious pseudo-anonymous Satoshi Nakamoto. The identity of the person or persons who created this technology is still a mystery. The main attraction for Bitcoin is that it typically offers lower transaction fees than traditional online payment mechanisms, and it comes from a decentralized authority, unlike currencies such as the dollar that comes from the Federal Reserve or the euro, which comes from the European Central Bank. There are no physical Bitcoins, only balances that are kept in a public ledger that everyone has transparent access to. In addition, Bitcoin transactions are verified by a massive amount of computing power. Bitcoins are not backed by any financial institution such as a bank or government, nor is it backed by any individual value that would make it a commodity. Despite Bitcoin not being of legal tenure, it is very high in popularity. It has spawned hundreds of other virtual currencies known as altcoins. Bitcoin is a collection of computers, or otherwise known as nodes, that run all of Bitcoin's codes and store its blockchain. Blockchain can be thought of as a collection of blocks, and each block is a set of transactions. Because all of these computers are running the same blockchain, have the same list of blocks and transactions, and can see when new blocks are being created with new Bitcoin transactions. The idea is that no one can cheat the system. Anyone, whether they run a Bitcoin node or not, can see all of the transactions occurring live. In order to really cheat the system of Bitcoin, a person would have to have the ability to harness 51% of all the computer power that supports Bitcoin. To put that in perspective, Bitcoin has around 47,000 nodes as of May 2020. For a person to really cheat the system, they would need to have at one time around 23,500 nodes to be able to really game the Bitcoin system. But here's where it's highly unlikely, is that number is growing exponentially on a daily basis. So they would need to continue to harness around 51% in order to really be able to cheat the Bitcoin system. That makes an attack highly unlikely. Let's assume that an attack does happen and a hacker is able to gain access to the Bitcoin system. What is likely to occur is the Bitcoin nodes or the persons that are a part of the Bitcoin network on their computer will just fork over to a new blockchain, making the hacker's efforts a complete waste of time. Bitcoin is a type of cryptocurrency. The balances of Bitcoin tokens are kept on public and private keys, which are a long string of numbers and letters that are linked together by the mathematical encryption algorithm that was used to create the key, which is very similar to a bank account routing number, is published for the world to be able to utilize, and is the address where others can send Bitcoins. The private key is similar to an ATM PIN number, something that is closely guarded secret and should be only utilized to authorize Bitcoin transmission. Bitcoin keys should not be confused with a Bitcoin wallet. A Bitcoin wallet is both a digital or a physical wallet, which is used in trading Bitcoins, and users use it to be able to track ownership of their coin. The term wallet is not your traditional sense of wallet. Because Bitcoin is a decentralized currency, it is never stored in any particular one place. What the wallet is referring to is the blockchain that is used to be able to track Bitcoin trading as well as ownership of those coins. Bitcoin is one of the first digital currencies to use peer-to-peer technology to be able to initiate instant payments. The independent individuals and companies that own all of the computing power and participate in the Bitcoin network are comprised of nodes or miners. Miners are the people who process Bitcoin transactions. They are typically motivated by rewards. Those rewards would include the release of new Bitcoin as well as transaction fees in Bitcoin. Even though Bitcoin does not have any type of centralized authority or process, in many ways these miners become the decentralized authority for the Bitcoin network. New Bitcoin is being released to these miners at a fixed but periodically declining rate, with the total supply of Bitcoin approaching around 21 million. As of July 2020, there are around 3 million Bitcoins that have yet to be mined. Here's the difference between Bitcoin and, say, a fiat currency such as the US dollar in a centralized banking system. The US dollar is released in conjunction with the growth rate in goods in order to be able to maintain price stability, while Bitcoin, its release date is set based upon a predetermined algorithm. Bitcoin mining is the process to which Bitcoins are released into circulation. Generally, mining requires the solving of computationally difficult puzzles in order to create a new block, which then can be added to the blockchain. Who invented Bitcoin? No one is known conclusively to be the inventor of Bitcoin. Satoshi Nakamoto has been the person closely aligned with Bitcoin through the white paper, but no one has ever seen him in person, and we still don't know conclusively is he the inventor or a part of a group of people who are the inventor of Bitcoin. Bitcoin can be accepted as a means of payment for services or products provided. Brick and mortar stores that are typically either at a mall or a strip mall typically will have a Bitcoin accepted sign letting you know that they are a merchant or a retailer that accepts Bitcoin as a form of payment. Many online retailers also now accept Bitcoin just as they accept PayPal and other forms of payment via their online transaction system. There are many Bitcoin supporters who believe that this is the digital currency for the future. They believe that because they feel that this is a faster, low-fee transaction that allows for payment transactions across the globe. Even though Bitcoin is not backed by any bank or governmental agency, it can be exchanged for currency that is backed by a financial institution or governmental agency. In fact, Bitcoin and its exchange rate against the dollar has been very attractive for a number of investors. One of the primary reasons for the explosive growth in Bitcoin is that it provides an alternative to fiat currency such as the US dollar and to commodities such as gold. Want to know how Bitcoin has arrived? In March of 2014, the Internal Revenue Service stated that Bitcoin and other virtual digital currencies will be taxed as property instead of as currency. In addition, the IRS further stated that the gains and losses from Bitcoin will be realized as capital gains and losses, while holding Bitcoin in inventory would incur ordinary gains or losses. Furthermore, the sale of Bitcoins that you have mined or purchased from another party, or Bitcoins that you have used for the purchase of goods and services also can be taxed. The most popular way of acquiring Bitcoins is typically through a Bitcoin exchange, but there are many other ways to be able to acquire Bitcoins. Even though Bitcoin is not your typical equity investment, many speculative investors were drawn to Bitcoin as its value significantly increased in both May of 2011 and then again in November of 2013. In reality, more people have purchased Bitcoin potentially for its investment value rather than a new medium of exchange. A couple things to keep in mind with the risk associated with Bitcoins. One is that it has a lack of guaranteed value. That continues to fluctuate. Also, it is a digital currency. There is no physical paper trail of Bitcoin or any of the transactions other than the public ledger that the transactions are listed upon. In terms of investing, you want to be aware of the risks that are associated with Bitcoins. The lack of guaranteed value and the digital currency platform are both inherent risks that are associated with the trading and acquiring of Bitcoin. Due to the popularity of Bitcoin, several regulatory agencies have been forced to issue warnings and directives regarding Bitcoin. Those would include the Securities and Exchange Commission, FINRA, and the Consumer Financial Protection Bureau. Keep in mind, the concept of a virtual digital currency is still a novel concept. And Bitcoin, having not been around very long, doesn't have a long track record in comparison to traditional currencies that have been around for many, many years. With the increased popularity of Bitcoin And now, having been in the marketplace approaching almost a decade, there is more and more history that now is available for you to be able to compare and look at the track record of Bitcoin and other digital currencies. Investing in Bitcoin and other virtual digital currencies is not for the risk-averse type of investor. Bitcoin and other digital currencies have a lot of volatility. They are also rival to governmental currencies and potentially could be used in black market type of activities such as money laundering and tax evasion. Due to this volatility and the propensity of using it in the black market, several regulatory agencies have either moved to regulate, restrict, or ban the use and sale of Bitcoins altogether, and many have already taken the first steps to do so. For example, transactions of $10,000 or more in Bitcoin or other virtual currencies in many states now have to be reported and recorded to the financial authority in that state. The lack of uniform regulations at the federal and local level regarding the use of Bitcoins raises many questions about its longevity and its liquidity. Another consideration for Bitcoins and other virtual digital currencies is the insurance risk. When you look at any other investment, many investments are protected by the Securities Investor Protection Corporation, otherwise known as SIPC. FDIC insures deposits within banking institutions. However, generally speaking, Bitcoin and Bitcoin exchanges are not insured by any type of regulatory body. Therefore, the investor is left out on an island. If anything were to happen with any of the value or transactions for Bitcoin, they have the potential of losing their entire investment. In recent years, there has been a move to provide certain Bitcoin platforms and users with FDIC insurance, but it only applies to those transactions where cash is used in conjunction with Bitcoin. The volatility of Bitcoin and other digital currencies is not for the naive investor. The price of Bitcoin can fluctuate very wildly on a single trading day. The ranges that you can see in terms of price drops and price increases can be as much as an 80% drop and a 61% increase in a single day. Another part of the downside risk with Bitcoin is that fewer people accept Bitcoin as a form of payment for goods and services, it will lose its value as a currency. And the major factor associated with Bitcoin risk is that there now is increased competition. Whereas Bitcoin was the early entrant into the digital currency market, many of our traditional financial institutions have now begun to issue digital currencies that now will be in major competition with Bitcoin. Like other assets that could be included in retirement accounts, Bitcoin is not eligible to be included in tax-advantaged retirement accounts. In contributing to the blockchain, miners add and verify transactions across the network. For adding blocks to the blockchain, miners receive a reward of a few Bitcoins. The reward is halved for every 2010 blocks. For example, 50 new Bitcoins was the block reward in 2009. It currently is 12.5 for the same block reward. As of May of 2020, the next halving will occur, and that same reward will now be worth 6.25 Bitcoins. A variety of hardware can be used to mine Bitcoin, but some hardware yields much higher rewards than others. For instance, certain computer chips known as application-specific integrated chips, or ASIC, as well as graphic processing units, known as GPUs, can achieve much higher rewards. These elaborate mining processors with maximum computation power are known as mining rigs. One Bitcoin is divisible to 8 decimal places, and the smallest unit is known as Satoshi. If necessary, and if in the future miners accept this change, Bitcoin can even be divisible by even more decimal places. Let's look at a little bit of chronological history related to Bitcoin. In August of 2008, the domain name bitcoin.org is registered. Today, that domain is listed as who is guard protected. So the identity of that person who registered that domain name is not for public information. October 2008, a person going by the name of Satoshi Nakamoto makes an announcement via the crypto mailing list of a new electronic cash system that is fully peer-to-peer. This infamous white paper is the backbone and the foundation of how Bitcoin has been set up and how it is executed till this day. In February of 2009, the first Bitcoin block is mined by the name of Block 0, or otherwise known as the Genesis block. One of the risks that was discussed earlier would be the Bitcoin network being compromised, as you've seen from major retailers such as Target, or the credit bureaus such as Equifax, where they have been hacked and data has been compromised. Another risk that could be a part of that same thought process is disagreements among the current groups of Bitcoin miners and nodes that then forces a change in protocol and processes. The process is known as forking, similar to the utensil that you use to eat food with. There are two types, hard forks and soft forks. Hard fork is when a new coin shares transaction history with a Bitcoin up until a decisive split point. At that split point, a new token is created. Examples of hard forks in recent history would be Bitcoin Cash, Bitcoin Gold, and Bitcoin SV. A soft fork is a change in protocol, but is still compatible with the old system. Unlike the hard fork, which makes it a complete break and the old system is no longer viable and the new system that's created is the one that is being utilized going forward. Unlike fiat currency such as the US dollar, Bitcoin is a decentralized currency that is distributed and traded via public ledger that everyone has transactional access to, known as a blockchain. Since it was the earliest cryptocurrency on the market, Bitcoin has spawned many competitors that will challenge it as the world's premier digital currency. As a highly speculative and volatile investment, Bitcoin is currently being evaluated among many regulatory agencies to be able to come up with a framework and a structure for investors to become much more comfortable and mitigate its risk. What's in it for my money? As we have discussed regarding Bitcoin, it is the premier cryptocurrency as it was the first to market in 2008. However, with Bitcoin as well as any other investment, it's important to understand and research what type of investment it is, how that fits into your current portfolio, and what risk are you willing to take with this investment. If you are the type of investor that is not comfortable with wild fluctuations in value and the speculative nature of Bitcoin, both now and going forward in the future, this probably won't be the type of investment that you want to include in your portfolio. However, for those investors who are comfortable with its wild fluctuations and are using a portion of their portfolio to be able to use Bitcoin in a way that they find value that adds to their portfolio and provides an alternative to some of the fiat currencies that may be phased out over the next several decades, Bitcoin could be a very valuable tool and an asset to a portfolio. And there you have it, a summary of Bitcoin, its pros and cons, as well as its history. Please don't forget to smash that like button and subscriber button to become a part of the family and to get updated weekly content. Thank you very much for tuning in, and I will see you next time.